In Chapter 6, we're going to continue looking at consolidations with a couple of additional items being cash flow and the impact of taxes. We'll start off with cash flows using exercise 6.1. To the template from the publishers down here in the corner, I've added the comparison trial balances. Most of what we're going to look at here in this exercise is review from intermediate. In terms of prepping a cash flow, there's not really much difference when you do it on a consolidated basis. The key is to compare consolidated to consolidated and take those differences. So you'll see at the consolidated column, I took directly from the textbook, but because they were not consolidated in 2012, I had to create a consolidated column by taking the information given in the textbook for 2012 for each of the separate entities. And you'll see that all of the trial balances foot back to zero like they should. And this will be then the starting point for our comparison like we did in intermediate. But before we get there, let's go back up and do a DDE. And we see from the information in the text that they paid $640,000 for this acquisition. So the implied value, since they acquired an 80% interest, is $800,000, creating an NCI of $160,000. For that, if you look at the point when they acquired it, they got $200,000 in common stock. There was no paid in excess, and retained earnings was $300,000. So therefore, split between parent and NCI is 400 and 100, which we've seen in our prior chapters would be our D entry on the worksheet. In this case, we're not going to worry about that. We'll notice also from the exercise information in the textbook that the total excess in this case is attributable to goodwill, so that completes our DDE. And that just will give us some information in relationship to the consolidation, but it's not going to be as foundational as is when we're actually doing the worksheet. So now let's go down here to the corner where I have the comparative trial balances. And just like you would have in intermediate, we're going to take the difference between the two periods, and those differences are what we're going to use to create the consolidated cash flow statement. So we'll start off pretty easy. The increase in inventory, we know, is an operating item from our intermediate review. So we're going to take that and put it over here in operations. And I'm just going to make some notations here to the side to help us know where we put things and what's taken care of and how it splits out. The other one you'll see there set up already in the table for the consolidated cash flow is the liabilities. So let's go ahead and put that in as well. And we'll mark that off as to operations. There's two other items that you'll see in our cash flow statement over here related to operations. One is income and the other is depreciation expense. In this case, it's fairly simplistic. There's not a lot going on because we want to just illustrate the basics. So the change here in property, plant, and equipment is your depreciation. So we're going to put that over there as our depreciation. That leaves us only with net income. Well, net income comes from two sources. If you remember our consolidated worksheets, remember part of it is the parent and part of it is the NCI interest. So to get this, we need to look down here first of all at the consolidated or parent retained earnings. And if you look at the information in the textbook, you'll see that the net income in this figure right here is 150 less 10,000 that are parent paid dividends. So that's going to help us with part of it. The other part is in the non-controlling interest. There is net income of 10,000 less 1,000 in dividends. So our net income over here becomes the combination of the 150 and the 10,000, the NCI. And that creates our operating section. So our cash flow from operations is $200,000. Now because this is the year of the acquisition, Our acquisition was cash that went outside of the consolidated group to acquire the investment. So that's part of the cash flow statement in the initial year. So we need to subtract out the cash that was paid for the investment. So we're going to take the price paid with one adjustment here. We're going to subtract out the cash that was received. So the net amount that should go here is $620. So what that's going to do over here is, because we pulled out the 20, it's going to be net of our starting cash. So our total change here is going to be $81,000 that we're going to reconcile to when we get to the bottom. So we've accounted for that $20,000 in this change here. All right, now we're down to, oh, and I forgot to mark off this here. This went to operations with depreciation. So now we're down to our financing section, and you'll see the items over here that we have not yet accounted for. Well, two of them are the stock that was issued to help pay for the acquisition. So these two are both going to go to financing to account for that issuance of stock. So we're going to take the combination of these two amounts and put it in our financing section on the cash flow statement. Our dividends paid to controlling interest we saw was part of this retained earnings amount over here. So we're going to put in that $10,000. And then we need to put in the non-controlling dividends that we calculated over here. And that was a $1,000 payment to the NCI for dividends. So there you see our $81,000 that I just referenced up here. If you're looking at this though, you see that there's our beginning cash, our ending consolidated cash matches in, but there's two items I didn't account for yet. There's the goodwill and the rest of this change in NCI. And let me just demonstrate how that happens by taking the numbers below. So the total change that we're trying to account for here is $331. So accounting for the combination of those two changes is split out in several different areas. Part of it, remember, we recognized when we picked up the investment because we didn't record that anywhere. So that investment change is 620 of it. And then we also picked up, as you recall, 10,000 in net income or operations. And we also had 1,000 in the dividends or the financing section for the NCI. And that accounts for this total of the 631, the two numbers that we have there off to the side. You'll also note then that we do put a notation in the schedule of non-cash activity referencing the creation of the consolidated group in the year of acquisition. In subsequent years you wouldn't have that item. You would still see the impact of the NCI, things that went outside of the group. You would see the amortizations of excesses just being rolled in like any other depreciation, and it's pretty straightforward. So there's not much modification to the cash flow statement.